Hi, Drew. How are you?
Hi, good morning. I'm good. How are you?
Good. So I just did a post and I saw on PMI, and there were a lot of positive, comments about it and about how to get rid of PMI, which is your mortgage insurance, right? So when you can't bring 20% into, or you can't have 20% of equity in a property, then you have to get mortgage insurance. And
Right.
so after a certain amount of time, you can get rid of the mortgage insurance. So, Drew, when can you get rid of your mortgage insurance?
Yeah, PMI is interesting because it's really only related to mortgages as opposed to other types of insurance. So first, I want to be clear that PMI is not the same as homeowners insurance. You should always have homeowners on your property. PMI is actually a protection for the lender, for the bank, against foreclosure. And so if you have less than 20% down, that PMI, insures them to make sure that they don't lose money in the unfortunate event of a foreclosure. So it doesn't really help you at all. Some people think, oh, well, at least I have some insurance. Not for you. But there are essentially, I'd say, four categories of canceling. I apologize. It looks like a fight back there, but it's just two huskies having the time of their life. So there are, like I said, there's about four ways to cancel it. There's automatic termination. There's borrower initiated based on initial value, and then borrower initiated based on current value. So the first one, the automated cancellation, you don't have to do anything for. It's a legal requirement. They have to remove it from your mortgage after your loan hits 78% loan to value based on your original value. And so let's say you bought something for $100,000 and then you got PMI. As soon as that loan hits 78,000, then that PMI will drop off automatically.
Nice.
The other thing is, same concept, is that once your loan hits 80% loan to value based on original value, so what you bought it for, what you refinanced it for, whatever that value was at that time, then you can request it be taken off. This is kind of a tough one, and depending on your loan amount, your interest rate, it's not too long between that 80% and 78. So you might just want to wait for 78. But what we do is you basically request it from your lender, and they may require either a broker pricing opinion or an appraisal, and those things can cost some money. So if your mortgage insurance is like $300 a month, then yeah, do that as soon as you hit 80%. But if it hits, 80% and you're paying like $50 a month, you might actually be better off just or fine waiting. You can always call, but if they want, an appraisal, they're going to charge you for it, just to make sure that your value hasn't gone down. The third option is if your value has gone up significantly, and let's say you're based, you still only have 90% loan to value based on original, but you think that your home is appreciated, maybe you added a wing, maybe you touched it up, and you think the value's gone up. In that case, you can request it, and you definitely have to pay for an appraisal. And that appraisal will come in, verify the new value, and then you can drop it off. There are some requirements to that. Sometimes you need to hold the loan for at least 2 years before you can do that. And then you have to have a clean payment history, of course. So basically, as long as you're up to date, everything's current, then you'll be eligible for that. The fourth option, of course, is to just refinance. And so when you refinance, you're wiping out the old loan entirely. So you do not need PMI. If you can refinance to 80% loan to value or 20% equity in 6 months, then go right ahead, and that will get rid of the PMI just based on that new value on the refinance.
Yeah.
Obviously, most of the time you don't refi just for PMI because you have those other options. But ideally, you're getting a better interest rate and you're dropping that mortgage insurance.
That would be huge savings each month. I mean, like if you do both, but we'll see.
Exactly. That's when you really see the big savings. Those first years, actually, I'm expecting a lot of that right now for people that are putting like 10% down right now with 7.5% interest rate. In 1 year or so, if values go up, rates go down, and you can refi without PMI, it's going to save you a lot of money. Quick reminder though, FHA loans, you cannot cancel the mortgage insurance. You cannot request it off. If you put at least 10% down on an FHA loan, which, to be kind of blunt, it doesn't really happen much. It's just that loan doesn't, there's not a lot of benefits to that loan when you're only putting, when you're putting up to 10% down. Usually it's only good for like the 3.5%, 5% down. But if you put 10% down when you buy the house, then it will stay for 11 years.
Wow. I didn't know that. That's really interesting.
But it's because you always say you can't cancel it, but in reality, you can if you put 10% down, but no one really does that. So that's why it's generally the consensus is you just can't do it. It's easy to remember that way. And let's be honest, 11 years is going to be that's a long time to hold a mortgage. And it's sure, if you have a 2% interest rate, then maybe you just might be locked into that and have to wait the 11 years if you put the 10% down. And the reason that 11 years is there is that if you look at just an amortization table, it usually takes about 11 years for you to get from 90% to 80% based on original value, which is why also that automated cancellation doesn't happen a lot unless you're putting like 15% down, or there's actually a pricing benefit to putting like 19.99% down and getting PMI than just putting 20% down. So sometimes what has been done, what I've actually done with some clients, is you can put that slightly shy of 20% down, you get the PMI, and then it automatically drops off in about 12 months. That's like the shortest period you can get it for, is 12 months, because just the way that your amortization table works, it's like 12 or 13. And that's how long it takes to get from 80.01 to 78. But you can't change it before that because it's under 2 years. So yeah.
Nice. Well, that's really interesting that, I mean, there's so many different types of ways to drop it off. Like, I just assumed it would come off just when it was time, but obviously there's different options for everyone out there, and you just have to be on top of it if you want to. So nice. Well, yeah. I'm excited we talked about this because I think it's a really important thing for people to know, and it's not something that we talk about very often. It's just kind of like in the back of your mind. In a few years you can like request to have it off if you want. So yeah, I can definitely help you out.
And I'm the type of originator who, if someone comes to me and they say, I want to save some money, and I can refinance them and get them maybe an 8% interest rate lower, but really all they're saving is coming from dropping their PMI, I'll tell them to go and try and drop the PMI first. And if they can with their lender, then you probably don't need me, so really, just if you go to your trusted originator, they should be able to tell you, yes, we can save you money if we refi, but you might actually be just as well off just, talking to your lender. And so they're going to be your best resource for knowing exactly what it is. They're going to have all the documents of knowing what your home sold for, refied for. They have the amortization table right in front of them. It's part of our system, so we can help.
Nice. No, that's good to know. So thank you, Drew, for all of your information today. And I hope that was very helpful for everyone out there. And if you want more information about PMI or just loans in general, please message Drew. So
here to help.
All right. Bye, everyone.
Bye.
Bye, Drew.